According to many stock market experts, investors are now experiencing the biggest U.S. fantasy trip of all time, thanks to reckless Federal Reserve policies, trillions in government stimulus, and the speedy vaccine distribution. However, the crazy market mania will likely end in tears as major risks are being overlooked. It's been just over a year since the last stock market crash, which led to a 35% drop, and then the fastest rebound ever recorded. Fueled by an unprecedented amount of printed money, record low interest rates, investors' speculative frenzy resulted in what's being called the greatest stock market bubble of all times. And various measures can prove so. Debt and margin levels are at peaks, trading volume is indicating bullish sentiment, and volumes on call option volume and over-the-counter penny stocks are at records. The last 12 months have been a classic finale to an 11-year bull market, said Jeremy Grantham, financial historian and co-founder of the investment firm GMO. Checking all the necessary boxes of a speculative peak, the U.S. market was entitled, historically, to start unraveling any time this year. Things are even more dangerous this time around because the bond, stock, and real estate markets are all inflated together, Grantham added, highlighting that even commodity prices are soaring. That trifecta and a half has never happened before anywhere. The closest before was Japan in 1989, he said. The consequences for the economy were dire, and neither land nor stocks have yet returned to their 1989 peaks, he exclaimed. It seems that we're now on the same path that pushed Japan to economic ruin in the early 90s, but today the stakes are even higher, since one market failure can lead to the simultaneous crash of the markets that glue the financial world together. To analyze today's market bubble, it's necessary to start by looking at what Grantham and several others have been calling the most inflated asset, and that is Bitcoin. Grantham, a historian of bubbles, explained in a wide-ranging Bloomberg interview that Bitcoin is in a bubble similar to the Nasdaq at the peak of the dot-com frenzy of the early 2000s. Back then, the Nasdaq 100 fast and furious 50% drop was a major warning sign for the broad market, but many decided to ignore it. Right now, the same is happening to Bitcoin, which declined by 50% over the past 2 months. Jeremy Grantham said, probably the asset that most resembles the Nasdaq in 2000 is Bitcoin, and it has been cut in half over the last several weeks. In 2000, the Nasdaq crashing 50% was a perfect warning shot for the broad market 6 months in advance, Grantham outlined, suggesting that the recent Bitcoin crash could be interpreted as a signal of an upcoming stock market crash. Although some crypto bulls argue that Bitcoin isn't directly correlated to other asset classes, and therefore they defend that investors should include an allocation to it in their portfolios, according to Grantham. Bitcoin should be avoided because it's not a viable hedge. The same logic applies to Dogecoin and other meme cryptocurrencies. Dogecoin was created as a joke to make fun of cryptocurrencies being worthless. And not only has it taken off, but it's such a success that second-level joke cryptocurrencies making fun of Dogecoin have gone to multi-billion-dollar valuations. Meanwhile, other cryptocurrencies have seen success purely on the basis of their scatological names, Grantham said. Cryptocurrencies total over $1 trillion of claims on real global assets, while adding nothing to the GDP pool. Pure dilation, the expert noted. Of course, Bitcoin isn't the only bubble out there. but its downward trajectory is making market veterans who predicted previous crashes extremely worried. A couple of weeks ago, Robert Kiyosaki, famous investor, author of Rich Dad, Poor Dad, tweeted the following: "The biggest bubble in world history is getting bigger. The biggest crash in world history is coming. I'm waiting for Bitcoin to drop to $24,000. Grantham and Kiyosaki's warnings were just the latest of the cautionary advice coming from long-term market watchers. In an interview with Business Insider, Tays Asset Management CEO and founder Phil Tays compared the insanity of the current market to tulip bulb mania in the Netherlands. Now, the tulip mania is one of the most famous stock market bubbles in history. It took place during the 1600s when the price of exotic tulip bulbs surged to today's equivalent of hundreds of thousands of dollars. Obviously overvalued, prices sharply plunged, and the bubble burst. We're living in history through something that's as bizarre as tulip mania, and everybody's just like saying it's fine, he described. On April 9th, Tays, who's been an investment manager for 3 decades, posted this on the company's website. It used to be that excesses were followed by depressions, which allowed for inefficiencies to be worked out of the system. However, through efforts of the government and the Federal Reserve, the natural cycle of boom and bust seems to have been replaced by a boom-boom cycle, interrupted with sporadic and spectacular temporary market crises. A confluence of events that includes easy money and government stimulus has created a situation where we no longer have to look back almost 400 years to tulip mania to wonder how could such lunacy prevail. We are now living with real-time examples of modern digital tulip-level bubbles. Despite these excesses, with economies reopening and fiscal stimulus still flowing, we may still be in the early stages of what may later be viewed as the bubble to eclipse all prior bubbles, he alerted. Over the past 12 months, the pace of stock price growth has been simply outstanding. Despite all of the economic turmoil we're still facing, the S&P 500 and other indexes have been recording one record high after the other, and several stocks are hitting new highs with each passing day. Meanwhile, the number of IPOs has skyrocketed. There's been an epic rush of special purpose acquisition companies, or SPACs, which have raised $400 billion from investors to pursue acquisitions throughout the past year. It's undeniable that this investment environment has become dangerously euphoric, especially considering that most new investors have been fueling stock bubbles of new, unproven companies in an attempt to make a quick buck. Evidently, speculators are often attracted to the easy gains a stock bubble can sometimes offer, but things can get out of control pretty fast, wiping out all of these gains before investors even have time to close down their wallets. As Michael Burry recently noted, amongst the telling signs of rampant speculation in the market are the huge increases in volume and prices in formerly under-the-radar stocks, as well as the enormous popularity of penny stocks and the increased amount of dubious investing advice on message boards and stock touts. It's in times like these that speculation reaches a fever pitch, and since valuations aren't supported by tangible economic prospects, investors are set to get bitterly disappointed. Now, of course, during normal times, stocks go up when they release good news, such as sudden upside earnings, and fall when they don't meet investors' expectations. But when the stock market's in a bubble, investors run to buy stocks regardless of bad news and bleak outlooks. They tend to come up with excuses for underperforming stocks and choose to stay optimistic about future growth. In these situations, stocks go up no matter how big the risks seem to be. Suze Orman, a personal finance media personality, has also warned about this issue, saying, "I like what I see happening in the market right now. The economy has been horrible, but the stock market has been going," she said in a video for CNBC. Exceedingly high valuations, both Tays and Orman add, have considerably contributed to making the current stock market bubble ready to burst. One major example of it can be seen in tech stocks, which skyrocketed this past year, despite the fact that many of them failed to meet their earnings expectations. Ultimately, this market will fail, and potentially spectacularly fail, primarily because of valuations, Tays stressed, affirming that he expects a downturn of about 30% as the economy rebounds, and the Fed will have no choice but to hike interest rates again. Orman emphasized that these kinds of markets do not benefit the average American at all, and cautioned investors of an important thing to always keep in mind: the stock market is not the economy. Billionaire investor Ray Dalio, who spent years studying stock market bubbles and economic cycles, has alerted about the same problem during a recent Robin Hood conference. The founder of Bridgewater explained that the top 5% of stocks are in a huge bubble. Once that bubble pops, it'll spark a cascade of other failures within the market. All of these warnings are exposing the ever-growing cracks in the Wall Street plumbing, pointing out that a devastating crash can occur at any time. At the end of March, one under-the-radar hedge fund, Archegos Capital Management, blew itself up, taking down by 50% the share prices of some of the stocks it had pumped up using 85% leverage. Several big investment banks had made the highly leveraged margin loans to Archegos, such as Credit Suisse, Nomura, UBS, Morgan Stanley, and others. When Archegos couldn't meet the margin loans and collapsed, the banks lost more than $10 billion. But that financial disaster revealed that Wall Street big banks were engaging in their old games again, secretly loaning out their balance sheets to hedge funds while denying to the public and regulators its ability to see the massive levels of concentrated risk. At this point, the only thing holding the Wall Street house of cards together is the New York Fed's willingness to pump trillions of dollars into the financial markets at the earliest sign of a hiccup. The problem is that the New York Fed is essentially owned by these same Wall Street big banks, while at the same time it creates emergency bailout programs, then outsources the work to the banks being bailed out. As the economy reopens and inflationary pressures mount, there will be no other alternative to prevent the economy from overheating rather than rising interest rates. Needless to say, speculators will overreact and sell off their risky assets, taking the market down at a time its foundations have been corroded by the imbalances created by the current monetary policies. But one thing is certain: when the stock market bubble bursts and an epic crash occurs, Federal Reserve Chairman Jerome Powell won't be able to sit before Congress and tell lawmakers that nobody could have seen it coming. All of these market veterans have been warning for months that we're about to witness a crash of unprecedented proportions, and all of those who have decided to ignore the risks will face a reckoning they will never forget.